Hello, listeners. Welcome to the Pre-Market Update. The podcast is powered by AI. I'm Joe.
And I'm Sarah. Today is February 6th, 2026. Let's dive in.
It looks like we are heading for a cautious, if not outright rocky, start for the Indian markets today. The GIFT Nifty is currently trading around the 25,600 level, indicating a gap-down opening of about 115 to 140 points for the Nifty 50. This comes as the domestic market braces for the Reserve Bank of India's policy announcement later today. Yesterday, the Sensex and Nifty were already showing signs of exhaustion after a three-day rally, with major laggards including Interglobe Aviation, Bar Electronics, Axis Bank, and Larsen & Toubro. We're also keeping a close eye on the F&O segment, or futures and options. SEBI, our market regulator, has proposed tighter margin rules for single-stock derivatives. Essentially, they want to limit the offsetting benefits on the day a contract expires to reduce systemic risk. This could dampen some of the speculative volume we see during expiry days. Additionally, the India VIX, often called the fear gauge because it measures expected volatility, saw a slight dip yesterday. But with the RBI policy on the horizon and in negative global cues, I'd expect that volatility to spike back up today.
Things aren't looking much brighter on the international front, Joe. We saw a significant tech rout on Wall Street overnight that is now rippling through Asia. In the US, the Nasdaq and S&P 500 took a hit, largely driven by a massive sell-off in software and big tech names. Over in Asia, South Korea's Kospi is leading the losses this morning, as the global sell-off in risk assets sweeps up tech heavyweights. Japan's Nikkei is also under pressure, though we did see some individual bright spots there which we'll discuss shortly. In the currency and commodity space, the U.S. Treasury yield curve is at its steepest level in 4 years, reflecting concerns about persistent inflation and the fiscal deficit. Meanwhile, in commodities, iron ore has slipped below the $100 per ton mark due to slowing demand in China ahead of the Lunar New Year. Even Bitcoin hasn't been spared. After a period of Trump trade euphoria, retail investors are getting a harsh lesson in market gravity as the cryptocurrency steadies only after a significant fall.
Back home, the corporate landscape is shifting in a very interesting way. We're seeing a historic trend where Indian company founders have slashed their holdings to an all-time low. Conversely, local domestic funds now own a record 20.6% of the Nifty 500 stocks. This suggests a massive institutionalization of the Indian market, where professional fund managers are picking up the slack as promoters divest. In specific stock news, keep an eye on Bharti Airtel and Tata Steel, both of which faced selling pressure in the previous session. We're also tracking the fallout of the new U.S.-India trade deal. While it's being hailed as a win for lower tariffs, the hard part is just beginning. The deal reportedly hinges on India agreeing to stop purchasing Russian crude oil, a move that would have massive implications for our energy security and the bottom lines of state-run oil refiners.
Moving to international corporate stories, the big story is Amazon. Their shares tumbled 10% after they forecast a staggering $200 billion in capital expenditure for 2026. Investors are clearly spooked by the sheer scale of spending required to stay ahead in the AI race. We also saw Estée Lauder's stock sink over 20%, a brutal move. They're projecting a $100 million hit to their annual profits specifically due to new tariffs. It's a clear sign that the trade war rhetoric is starting to show up in real corporate earnings. However, it wasn't all red. Roblox shares rocketed 20% on a strong earnings beat and a very optimistic forecast. And in Japan, the seasoning giant Ajinomoto saw a 10% rally. Apparently, strong coffee and seasoning sales are recession-proof even in this environment. Lastly, keep an eye on Trafigura, which is in talks with China's ITG to form a new commodity trading venture, signaling that despite geopolitical tensions, raw material trade remains a priority.
On the broader economic and geopolitical stage, all eyes are on the RBI today, but the global backdrop is getting complicated. Shipping experts are warning that the current GDP forecasts might be an economic mirage caused by the looming trade war. Essentially, Companies are front-loading freight to beat potential tariffs, which artificially inflates current growth data while masking a future slowdown. This mirage makes the job of the U.S. Fed and our own RBI much harder. If they misread this temporary bump as sustainable growth, they might keep interest rates higher for longer than the economy can actually handle. Furthermore, the U.S. is currently pushing to form a critical minerals trade bloc specifically to counter China's dominance. This is a significant geopolitical shift that could force India to pick sides in the global supply chain for EV batteries and high-tech components.
To wrap things up for our investors, the key takeaway for today is caution. Between the GIFT Nifty's weak start and the impending RBI policy, this is not a day for aggressive long positions without a clear signal. Globally, we are seeing the tech-only rally start to crack under the pressure of high capital expenditure, as seen with Amazon. Investors are rotating into non-tech names, like Bristol-Myers, which has been outperforming during this dip. In India, the focus will remain on the central bank's stance on inflation versus growth. If the RBI remains hawkish, meaning they prioritize fighting inflation over cutting rates, we might see further pressure on rate-sensitive sectors like banking and real estate. Watch the 25,500 level on the Nifty closely. If that breaks, we could see the correction deepen.
That wraps up today's update. I hope you gained useful insights to navigate the markets today.
Add your thoughts in the comments and follow for more such updates. This is Sarah
And Joe, signing off.